Grand Portage Resources recently completed the 2018 drill program on its 100% controlled Herbert Gold Discovery property located in the prolific Juneau Belt in southeast Alaska. Drill results are expected through late 2018. Past drill results included numerous multi-ounce gold assays on multiple veins. Grand Portage trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Welcome back to the show, Danielle.
Hey, thank you, Jim.
The U.S. Fed did not hike interest rates at their last meeting, and Jerome Powell, the chairman, seems to be his own master. He's not like previous Fed chairs, and he also seems to be doing a good job of ignoring sharp criticism from President Trump. What's your opinion of the Fed head?
Well, he's a lawyer, so I was hopeful that he might be more rules-based than some of the pure PhD economists. But I would say that he is being yanked by the same leash as they all have, which is the stock market. Ultimately, when the stock market declines, they all capitulate and start trying to ease or say that they'll ease or add more liquidity. So, quite simply, we saw in the fourth quarter of 2018, we saw the steepest, the speed of the mean reversion was as sharp from the third to the fourth quarter, was more than even in the third and fourth quarter of 1929, leading into the Great Crash. So it was extremely dramatic, and it evaporated $16 trillion of paper wealth in 2018, mostly in the last 3 months. So you get a bold decline, a sharp decline like that, and it gets everyone's attention, especially in the central bank. Now, Jerome Powell's been on the committee at the central bank through the past several years, just like his predecessors. Bernanke was under Greenspan and Yellen was there as well. And they all subscribe to the same rule book, which is add liquidity, continually add liquidity to the system, even when the system is toxically, poisoned by too much liquidity, even when they've created asset bubbles all around the world. Even when they've, for example, doubled the number of billionaires since 2008 in the world. There was 1,100 in 2008. There's now 2,200. And the amount of wealth that they control has also doubled in that 10-year period. So the produce of their excessive monetary intervention, both the zero-bound strategy, which left rates at less than the rate of inflation over the last decade, that as well as their quantitative easing that pumped trillions of dollars into financial assets has only, enriched the people that were extraordinarily wealthy to begin with and holding, tons of assets that didn't have to worry about declines because they have so much money that they, it's not like they would be impacted in terms of their plan or their retirement plan or anything like that. Meanwhile, the average working person, and indeed the rest of the population, have to be concerned about massive drops in their net worth and violent swings in the economy, the way in which the job market is hit when these bubbles burst and people are not able to cover their basic expenses. So all this is, it's unfortunate that he capitulated so quickly. I mean, it only took a 20% decline in the S&P for, the central bank to say that they were pausing in their rate hiking plans. And think about that, Jim. That means that the overnight rate that they were at was, 2.5, and they said they were projecting inflation at 2%, although it's now expected to be more like 1.6 or 1.7%. But ultimately, if you look at it, they're saying that first of all, he starts out by saying the economy is in great shape. And the next thing out of his mouth is that we can't afford to raise rates more than 0.5% above the cost of inflation. Essentially, that's what they're saying, because if the Fed funds rate is at 2.5 They're saying inflation, in their view, was close to 2. They're saying they can't afford to have a real rate of more than 0.5% without the economy taking falling into recession. And that's just a statement of how fragile they've made the world economy with all these interventionist policies. It's not productive, it's not healthy, it's not helping, it's making matters worse. And what's more, even if they, so they go to a dovish bias in the stock market, the U.S. stock market, jumps 1.5% in response yesterday, which looks dramatic, but really it's 1.5%. They're still significantly lower than the peaks were in October and July when the market cycle peaked out. And even if they stop hiking now, Jim, even if they do nothing further, the hikes that they've already implemented from December 2015, and in the case of the Canadian Central Bank since 2016, the hikes they've already implemented are still going to work through the financial system into the real economy at a lag of several quarters. So there's nothing that can be done right now from central banks to reverse or arrest the downtrend that's already well underway in the global economy. And the down cycle that began from the peaks in 2018 in terms of financial assets is not going to be arrested either. I mean, they can, these sharp rallies are par for the course for bear markets. It's typical. But it doesn't reverse the overall trend, which deserves to go down because things have become so overvalued, thanks to their policies. So, it's a sad state of affairs. There's no leadership, there's no responsibility or adults in the room. It's just throw more debt at it and hope for the best. And ultimately, that has made us a much less stable system, much less anti-fragile, and much more vulnerable, which we're all paying for and which we will now pay for again as the world economy continues to slip. Just a few stats, Jim. Italy is already in a technical recession. Germany's retail sales fell 4.3% in December, and that suggests that their fourth quarter GDP number, which is due out tomorrow, is also going to be a technical recession for, one of the most important economies in the world and certainly in the Eurozone. At the same time, you've got China PMI manufacturing data, which contracted for the second straight month in January. We just set that data. So these are the so-called engines of the world economy. And as I say, the U.S. economy being so weak that they're now saying they may have to, not raise rates past 2.5%, and they may indeed have to go not only stop or reduce the amount of quantitative tapering, they may have to hold these trillions of dollars on their balance sheet and indeed go back to buying more assets and trying to keep the economy from registering a technical recession. So it's a sad state of affairs. We have a very weak global economy. Recessions are part of the normal process, but because they keep kicking the can and trying to stop that normal cleansing process from happening, we end up with the mess that we have now.
We'll have more with Danielle Park right after this.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Welcome back. We're speaking with Danielle Park. Danielle, governments across Canada say they want to make housing more affordable. Is there anything governments can do, or should they just let natural market forces look after it?
Governments have been so instrumental in the bubbles that we have right now. The fact that, the housing prices have got so extreme. Here's a really important thing to keep in mind. Very high housing prices come with very high levels of household debt, that the two are married. And so by allowing lax lending policies and indiscriminate inflows from foreign environments, we have really done Canadians no favors. You know, Toronto and Vancouver were named as two of the top of the 4 worst valued cities in the world for housing last year, and that's therefore no surprise that we also have some of the worst household debt ratios in the world. And so the reason that happened was that we had, first of all, the central bank putting the rate so low, again below the cost of inflation for many, many years, banks being eager to get into all sorts of sketchy loans. I saw TD announce this week it's doubling down on HELCO loans, Jim, home equity lines of credit. This is its new brilliant idea on how to get extra growth in 2019, is to double down on a product which has already been widely abused by Canadian households, much to their detriment. So, this is the problem. Banks driven by quarterly revenue and earnings targets continue to sell, even when their customers are completely emaciated by the bad advice and toxic products they've been consuming. So we have these two policies driving, not only that, but there was another report that showed money laundering out of China in particular has sent trillions of dollars into global housing markets in places like Australia and Canada. So we've had, lax regulation on money coming into the country. A bunch of groups were against, being very careful or selective because they thought it was a great thing that funds were flowing in. You think about the banks, the mortgage lenders, the mortgage brokers, the real estate brokers, the people that were, making the most commissions off the sales as the prices continued to soar were supposedly, doing a great thing. They were getting lots of revenue, but on the other hand, the cost is the debt and the unaffordability that goes with the housing crisis. So the worst thing that a government should be doing here is trying to intervene to make it, quote, easier for people to buy too expensive housing. What they need to do is stop subsidizing reckless risk-taking, to back off and allow interest rates to find market levels, because what will happen is that housing prices will find market levels. In other words, they will decline where they are not sustainable. And that will become improve affordability in its own way, in its natural way, that free market forces are supposed to work. But governments need to get out of the business of trying to get people to afford more and more expensive housing. It's a recipe for disaster. It means that debt levels are high in governments. It means debt levels are high in households. It means properties are unaffordable. It just is this, cascade of problems that ought not to be there if they would back out and let people save down payments, which is in their best interest to do. It is not actually in anyone's best interest to go reaching for things they can't actually afford by putting themselves, decades and decades in debt. And indeed, you're seeing this happen now where properties that were bought near the peak in many of the hot areas in Canada, had negative rent carry or had no rent carry in some cases. So people were just buying things with negative cash flow, assuming that they would go higher. So that they just held them for long enough and paid, even if it was costing them monthly to hold it, even the so-called investment property costing them monthly instead of having rents more than amply cover the cost of carry. They were doing that on the assumption that prices would go up enough that it would make sense and they would cash out. Well, of course, prices have been going down now, Jim, as you know, for the last year and a half. And so what happens is people for a while continue to try and keep that up, literally wasting money every month out of their own pocket to cover the carry on these so-called rental properties. And what ends up happening is that they burn through their savings or they burn through their cash flow, and they get to a point where they can't do it, either because they run out of savings or because the house prices come down so far they can't tolerate the reality of their mistake any longer and they want to sell and get out of it. Or in other cases, they're trying to help adult children. So this was something that many people were doing in the past few years too, trying to help their kids, so to speak, help in quotation, get into housing they couldn't actually afford. And what happened was they give them the down payment, and then when, the child can't actually, doesn't have sufficient cash flow to cover their own expenditures in that place, the parent gets sucked into trying to subsidize that. And this happened in the real estate bubble in 2006, for example, in the United States, this happened, and people ended up, blowing whatever savings they had into the dark hole of overvalued housing as prices collapsed. So I think it's a terrible strategy. And the idea that you help people by allowing them to buy things they can't otherwise afford, by loans, and by taking on, too much expenditure is a disastrous plan. It is not actually helping them at all. And, even as much as we talk about Canada, it's important to understand that in the United States, the year-over-year decline in new home sales was 10% in December. The last time we saw this trend, Jim, was in the 2006 top and burst that happened in their housing bubble as well. So I think Canada's housing bubble is more extreme this time than the United States, but right now we're seeing a simultaneous deflation in both housing markets at the same time, not just in Canada. I shouldn't say just both. I mean simultaneously around the world. And the biggest so to speak, world-class cities that had the highest price gains, that saw the greatest inflows from foreigners in the past decade, are the ones who are declining the fastest now. So you're going to see a hit, because that's where all the people that own the most expensive housing in the world are the same 10% of the population that owns the bulk of the, quote, financial assets, the stocks that have been falling as well, the corporate debts that have been falling. So they are getting hit on all sides of their balance sheet. They're also the ones who drive the bulk of the so-called luxury spending in the world, luxury car sales in the world. So, they've made this deal with the devil in inflating asset prices in the last decade, and the people who were holding those assets, had knockoff effects in terms of consumption. But the reverse is also happening now, where the bulk of the consumption that has materialized in the last decade around real estate, around luxury spending, around luxury car sales, those things are all reversing now at once for the same reason. So the stock market has become the leading indicator for recession in the world. It used to be just one of the indicators. Now it's the leading indicator. So because of its overinflated nature and the way in which central banks have, continually goosed it to try and keep the train going, the consumption train alive, they have really made a monster that comes back to eat us now, and that's really what's happening.
Has there been too much of a connection where people believe, or governments, that a well-doing or a healthy stock market is the same as a healthy economy?
Oh, totally. I mean, you hear it from the Trump administration, which is a farce. He was taking credit for the stock market going up as soon into his term. And anyone with common sense was saying, if that's the last thing in the world you want to associate yourself with in terms of your performance, because it will also enter a bear market where at these valuations it's likely to drop 50%. And, you're going to wear that. If you've tried to own the upside, you're going to wear the downside. Of course, no one wants to wear the downside. They always want to take credit for the expansion and for the adding debt phase, but they never want to take responsibility or admit that they were reckless or did, foolish policies during the expansion when the contraction comes. So it's not the same thing at all. The economic cycle, we've seen that big decouple between price gains in some assets. As we've said, the U.S. stock market is the primary recipient of the inflows from the QE policies that have gone on in the world. So it had this astronomical explosion in the past, say, between 2013 and 2018. It really exploded. For the years before that, Jim, from the downturn in 2008, it took all the years from 7 to 13 just to try and make back the losses. So it's only been in the last few years of the QE expansion that U.S. stocks had such a huge explosion. And when they get to that level of overvaluation, it just means that they have that much downside. So again, trying to connect your performance as a politician to what's going on in the stock market is ridiculous. It's just like stockbrokers and managers who actually don't manage risk at all. They ride the stock market cycle up. they take credit as if that's their genius by having people risk exposed. They're borrowing money to participate in that. And of course, all that happens is because they aren't actually managing anything about downside or fundamentals or anything, or what's best for the client, what's in their best interest, should they actually be buying risk assets or should they be paying down debt? That sort of thing is the primary conversation that builds wealth the best over time. A focus on the actual balance sheet build of the human and their income, expenses, and what they're doing on that side is really how wealth is created. But everyone wants to focus on whether assets have gone up fast in the assets they're holding. And of course, the problem is that they also burst, as I've said, in these bubble conditions. They burst and the values plunge. And then people find themselves back where they were 12 and 15 years before with no net progress. I mean, if you look at the TSX today, it's a prime example. We had the commodities boom and bubble into 2008 when everyone thought we could do no wrong, and the Canadian dollar lunatic fringe went way above the US dollar for a few months. And of course, that was a peak too. And since then, the TSX has actually gone nowhere now since 2007. And the Canadian dollar is, as you know, come back down. And our economy has struggled, and it's going to struggle more as we go into the latter phases of this housing bubble deflation. So, the problem with credit and leverage, it has the appearance of progress in a rapid fashion, but that progress is ultimately fleeting when the values burst and people haven't developed solid financial habits. And that's the fact right now, is that Canadians have developed poor financial habits through this experience, and so that will not serve them in the longer run.
We'll have more with Danielle Park right after this.
I'm Kelly Jennings, CEO of PowerBand Solutions. PowerBand is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. PowerBand Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWPF and on Frankfurt symbol 1ZB. For more information, please visit us at powerbandsolutions.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, because we are in a situation where perhaps things are going to go into downturn, or if they haven't yet, will, what should a person be doing to protect themselves?
So, this is the stuff that is more boring perhaps, but it's pertinent, So basically it goes to controlling your spending and your expenditures. It means looking at your leverage, seeing if you owe a great deal of money relative to your assets and what the impact would be if the value of those assets decline. There's nothing wrong with, if you can restructure your affairs so that you pay down your debt, pay down your leverage, and build up your cash. There's nothing wrong with holding things like treasuries and GICs and savings deposits and things that are more stable in this environment. It's all about trying to preserve your savings rather than try and grow it quickly. And this is a long cycle. There's no question. We've been in this secular bear period from extreme valuations and extreme monetary intervention since 2000. So people kind of lose the plot here. But the fact is that we are now back at the tech wreck valuations and higher in many of the asset classes that we saw in 2000. So you experienced this if you've lived through the last 20 years where everything is, at all-time optimistic highs, and then it starts these legs down. So the behavior we've seen since October, the rebound in January, has not taken away the losses, but it certainly was a significant bounce. You should use those opportunities if you still have equity exposure to reduce it, to pay down things like margin. If you've borrowed against your home, God forbid, to buy things in the stock market, now is a good time to look at lowering that debt and selling things to raise cash. Because ultimately what happens is we'll get another bottom opportunity to deploy cash. But if you haven't built it up in the upcycle, if you haven't taken profits, you are not going to have the resources to deploy when things become finally attractive in terms of investment, when yields are much higher than they are today. So it really has to start with looking at your income statement and making sure you're not wasting amounts of money, building up reserve funds for if you do have a downturn in your income, whether it's employment or your business income, which is highly typical in this environment, that you see a downturn in most people's income. Making sure that you can afford your household expenditures, even if you take a hit to your income side. Making sure that you don't have all your assets in these highly correlated pots of things that go up and down in manic swings during a bear market and ultimately lose a ton of value. And here's the kicker, Jim, spend years thereafter trying to grow back the principal, right? So it's not a matter of just volatility. It's not a matter of just having, a bad couple of months. The fact is that in a true bear market, things decline and take years to recover. Just like in a true housing bust, Jim, it's quite likely that Canadian housing prices will not see the 2017 peak for years from now, potentially 10 years, maybe longer, because this cycle went on much longer than traditionally the cycles have. So, it's not a question of just what you think is going to happen in the next 6 months. It's a question of where we are in these major secular cycles and whether people are going to need to be raising cash when prices are much lower. And it's always a better strategy to do it in advance rather than do it after the fall. So, there's other people are trying to have their cake and eat it too in a lot of products where they've borrowed against housing, whether it's reverse mortgages, which are disastrous. I wrote an article recently on the blog about the impact of how reverse mortgages are terrible math for homeowners. I'd like people to consider stuff like that. A lot of the broker dealers of the world, financial planners, have got people to take out so-called investment loans to buy these products that they sell and make the sellers commissions, but at horrendous investment prospects. Now is the time. It's not too late to take a really hard look at your leverage and reduce it in a way to raise cash, to reduce your expenditures, to try and have more net savings per month and have a buffer. That's how you're actually going to prosper through this period and be well set up for the next cyclical rebound, which will come after we get the clearing out effect. But you have to be prepared for it. Otherwise, it'll just feel like you spent years going nowhere, and most people won't be able to wait that out.
Danielle, thank you so much for chatting with us.
Hey, thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. If you have any questions for Danielle or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet. You can find our YouTube channel at Talk Digital Network. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.